This is Alvin with Trying Success on the Old Fashioned Health Network, Good Health Inside and Out. And today we have Brandon on the show. Man, welcome to the show. Please tell the people a little bit about yourself and what you do and all the amazing things you got going on.
Oh, man. Well, first of all, it's an honor. It's a pleasure to be here. I was fortunate enough to meet you through a friend of mine, about a year ago?
Yeah.
We work in the same industry, in the same spaces I work in. For those of you who don't know me, my name is Brandon Anthony Clark, and I am a wealth advisor. I strategically operate in the realm of cash value life insurance and estate planning. And what I essentially do is take advanced concepts, financial concepts, and I just try to just make them simple. My background is not finance. My background is I grew up in South Carolina. I was raised by my grandmother. I played sports. I did go to college for criminal justice, but it's kind of like one of those things, especially with my generation, being millennials, born in the, late 70s, 80s, we were kind of taught that traditional path, go get an education. Nothing wrong with getting an education, but I think sometimes the importance of education falls second to like life skills and skills that you need to be able to function, I would say, as a productive adult in society. Right. Being able to negotiate, being able to learn things that you don't know, being able to go out and just make friends.
Right.
A lot of wealth is built on relationships. I heard this saying, this guy said, the more hands you shake, the more money you make.
The more hands you shake, the more money you make.
The more money you make. Why is that? Because number one, people buy from somebody they like and they trust. And so when you are, and this is something that I had to learn myself, because if you don't come from wealth, you have to kind of force your way into that environment. That's why, wealthy people hang out with wealthy people.
Right.
Poor people hang out with poor people.
Right.
People who work out hang out with people who work out. People who party hang out with people who party. Right. Birds of a feather flock together.
That's true. That's true.
Yeah. So my background, I got out of school in 2009 after playing football, and I went more of a traditional route of just working a job. Okay. A lot of times and I think my story is no different than most people. Mm-hmm. When you get out of school, the first thing you do is you find a job, and it's not even necessarily a job that you want to do. It's just a job that you got to take because you got to put food on the table. Right. You got bills to pay. Right. And so you just start working job after job. And then you just look up one day and be like, man, how did I end up here? You know what I mean? This isn't what I thought my life would look like at this, you know what I mean? So you kind of just do some reflecting, and that's what I did. I did some reflecting and some searching, and ended up getting into this atmosphere of what it is that I do now. And I think something that I don't talk about, I talk a lot about wealth. Right. Building wealth, generational wealth, financial literacy, financial education. But the biggest piece that's even more important that is developing as a person, people skills, right? Personal development is, I would say, would be the number one reason for kind of where I'm at today. I'm by no means where I want to be.
Okay.
But the trajectory, we going on the right path, meeting people like you, right. Such as yourself, giving me this opportunity here. I appreciate it.
No, man, I was on your podcast the first time, so I appreciate that. And I really enjoyed it. It was you and Ryan, I believe. They had a good time with, and I watch a lot of y'all stuff and the things that you do. And I keep up with out, and sometimes I'll come in and out of some of the classes that you may be teaching to try to teach. I'm impressed that a lot of times you have a lot of younger people on there making these big financial moves so soon, and they know the game so well. I was like, these guys are like young and they know the financial game. And are these people that you taking under your wings that you teach, or where these guys come from? Or is it what you said, wealthy people stick together?
Well, wealthy people do stick together. I have mentors who it's crazy. Sometimes when you meet like people who are wealthy, you would never know they were wealthy, right? At all. You just don't know. They don't carry themselves like how you think they carry themselves. But one of my mentors has been in this industry for about 25 years. He started when he was like 22. He's like 47, 48 now.
Okay.
And so he's a brother too. So that tremendously helps out. Just having somebody to connect with. You know what I mean? But as far as the guys that I've been working with, I'm assuming you're talking about like Anthony Enriquez. If you've seen him on
these are young guys, just like
young guy. Yeah, there's also Deontay, who I work with as well. So the background between me and Anthony, him and I used to work at a company together.
Okay.
And, when I kind of left that company and started the independent route, you know, it's kind of like leaving a major label and going the independent route. You know, so I kind of get just real busy, and then I needed help. And so I was looking for people I could trust, and Anthony just happened to be one of those people. So we just started working together. And then by us working together and just kind of marketing and things online, I ended up meeting Deontay. And Deontay is very, very special talent, very gifted brother, man. He's well-rounded in everything, not just finance, but he's like into, you know, politics, history, just so well-rounded, so well-versed with things. And so he's able to communicate in a way that I'm not even, able to communicate with, you know, because sometimes you have to hear things from different people so some people just communicate differently. Right. And so what I'll say might not click for somebody, but let's say if he says it or if you say it, then that might click for that person. And so we just, you know, they learn from me, but I wouldn't say they, I don't think they need me is what I'm saying. Those are smart guys, you know, we just happen to work together and we have a relationship, friendship.
Yeah, they are smart, man. To listen to how they break down the whole insurance game and how you should put your money here and put your money there. And then the guy that you talk about the political thing, he just turns off and on two different things. And it seems like you all, I think you all compliment the whole team. Y'all compliment each other. So
he calling right now. Look.
Oh, okay. Hey, what's up?
You know, we talk about him.
You know, we talk about it. Yeah. Man, y'all are good. I like the team you put together. Now, let me ask you something. Yeah. Is your whole thing that you do, is it specifically just to insurance, or are you also getting into the crypto and Bitcoin and all those kind of things? What are you is it insurance related stuff only that is your focus?
Right now it's predominantly insurance, right? And the reason why is insurance right now. Now, keep in mind, I do have other things that are going on behind the scenes that we're not ready to make public. Okay. They do involve crypto. They do involve, basically it's a hedge fund. And so if you guys don't really know what a hedge fund is, think about an insurance company. Right. Insurance companies, you pay premium and they take those premiums and invest them. Right. That's a hedge fund because they're just managing money or trying to get you a better return than you would otherwise go out and get yourself, just trying to invest, not really knowing what you're doing.
Okay, so let me get this right. So you're going to start a hedge. So I know you don't want to talk much about it now. You'll talk about it the next time you're on my show, right?
Next time.
Okay, next time. I won't get into that. Let's just go to the insurance thing. Please tell people how, from what I'm understanding, the way you talk about the insurance is you can take, let's just say $10,000 and you can take that money and make that money work for you. And the way you break it down so good I was looking at this one thing you did about mortgages. I said, okay, I got to get to the point where I can make my mortgage, my insurance investment pay my mortgage. So what I decided I would try to do first is start off with something small, like try to get enough into insurance where I could first start paying my car note. Then I'll graduate from the car to the house and then that boat that I want. So tell us again exactly, in the simplest term, exactly how they work. Let's just start with a small dollar amount. Let's just start with $5,000. What can a person do at a minimum? Can they at least take $5,000 and at a minimum pay their power bill?
Yes, they could, right? So the way you want to look at insurance is not, and it's so hard because insurance gets lumped into every other insurance, right? Because you got health insurance, that's a bill. You got car insurance, that's a bill. Right. You got renter's insurance, that's a bill. Right. And most life insurance is a bill because of how people buy it. Right. So you got to think about what we do that's why the education piece is so critical when it comes to insurance, because insurance is the easiest, most simple way to create long-term wealth. Okay. You literally are buying money for pennies on the dollar. Notice what I said, buying money. Nobody thinks about it like, wait a minute, buying money. what does that even mean?
Right.
Well, it means that if I had $100 and I bought an insurance policy that insured me for $1 million, I have a contract or a promise that I'm worth $1 million on paper.
Okay.
You see what I'm saying?
All right.
Now, just like you have a house that is worth $1 million or whatever the dollar figure is, that's an asset that you can leverage. And just leverage just means to use. It just means you can use your house to buy things. So I can use my insurance policy, the value of it, to buy things. So essentially what happens is I take all of my income and I pay my income as a premium into an insurance contract.
Okay.
Right? It's no different than taking all your income. Well, I don't know why you would do this, and this is why you wouldn't do it with a house. Right? It's why financial literacy is so important, because there's two types of loans that are out there.
Okay, two types. I want you to take us slow. I want to get this now. Two types. All right.
Or two types of credit. So you have a loan or an installment loan. So that's like your mortgage or your car payment, where you just take out a fixed amount of money and then you just make payments on it.
Okay.
And then you have revolving credit or a revolving loan.
Right.
And that's a credit card.
Okay.
So the difference between the two is, let's say if you had a car payment, and you say your car payment was $500 a month. Once you pay $500 on your car, you can't go back and respend that $500. That money is in that. You're paying that money back to the bank.
Right.
Whereas a credit card, let's say if you had a limit of $1,000 and you swiped all 1,000, right? So now you got no balance left on or you have a $1,000 balance on your credit card. But if you were to take even $500, pay it into your credit card, now you can spend another $500.
Right.
Does that make sense?
Yes.
So different types. So let's look at it this way. Traditionally, people are taught pay off your house fast.
Right.
Because you don't want to be paying all that interest. You want to own the house.
Right.
Okay, that's one thing. So sometimes people will make extra mortgage payments. Right. That is more money that is leaving their pocket and going back to the financial institution. Right. So if something happens, something comes up, they can't go back and ask for a refund of the mortgage payment that they just paid into the house, right?
That's true. Right.
The only way they can do that is to say if they got enough equity in the house to where they can refinance or maybe open up a line of credit. But that's subject to what kind of terms. You gotta have good credit, you gotta have income. It's subject to the value of the house, which can change everything, right? So let's say if I had an insurance policy and I wanted to take all of my income and pay it as a premium into the policy.
So hold on, let me get this right. So let's just say I bring home $5,000 a month, right? So I take all of that $5,000 and put it into an insurance premium. Is that right? Okay, and then tell me what happened after that.
So what happens after that is now I got two options to use that money.
Okay.
I could withdraw it. And withdraw just means simply like a regular checking account. That's how most people pay their bills. $5,000 goes into your checking account. And let's say your bills are, I don't know, $5,000 a month. Then you just go write checks and pay your bills.
Right. And you don't get nothing.
And now you only got $1,000 left. Right. And so when you have that $1,000 left in a bank account, it's not doing anything. It's not earning nothing. Right. It's not earning nothing. Whereas the insurance, I could do the same thing, right? I could basically either withdraw $5,000 and pay my bills, or I can loan myself $5,000 to pay my bills.
So I put it in Brandon's insurance company. All right. So I borrowed $5,000 from myself.
From yourself. Now that sounds crazy, don't it?
Sound good though.
People be like, it's good. So people be like, why would I borrow my own money? That don't even make sense. Why not just spend it?
So when I borrowed the $5,000, what's happening with the $5,000 that's in my insurance? Because now I took $5,000. So let's do it real simple. I borrowed $5,000 from myself. I took $2,500 and paid the mortgage. I took another $2,500 and paid all of my office expenses. How do I where am I making money at?
You're making money when you borrow your money. So when that money goes in the policy as a premium, you're going to earn anywhere between 0 to 10% on that money as it's inside of the policy per year. And that growth is tax-free, right? So think about it like the value of your home going up. Gets more valuable as time goes on. It's compounding, growing interest. Now, when you take a loan, and this is why you don't withdraw it, you take a loan because you're using your cash as collateral. You're going to say, hey, insurance company, I don't want to withdraw my money or use my money. I want to use your money, Okay. The reason why the insurance company lets you use their money is because you got $5,000 of collateral that you paid in your policy,
Right.
plus the death benefit of the insurance.
Right.
That serves as a repayment of your loan.
Okay.
So this is a loan that we're not even paying back because we already paid to borrow it because we have the insurance policy itself.
Right.
So let's say if I had $5,000 and I borrowed $5,000 and I spent it and I never repaid the loan, the insurance company is going to deduct $5,000 from that death benefit.
Oh.
You see?
Okay.
So now I just created a system where I can turn my cash, save my cash, and use my cash as credit. And let's think about how the effects of what this will look like over 20, 30 years. If your money's making on average 7% in your policy, but you can borrow against your money at 4%, even when you spend the money, you're still making, 3%? You're still making money on your money. Now let's take the same scenario. You take $5,000 and you spend $5,000. Now $5,000 is not doing anything. It's not making nothing. And now you got to go rework to make more money because you didn't put that money to work. That's what the Bible talks about. The Bible says, put it to work. You want to finance everything. Right. You never want to spend your own cash. OPM, other people's money.
I've heard quite a few people say that all the time. You want to spend other people's money, not your money. Right.
You think about how powerful words are. You think loan automatically means I'm going to get paid back. Right. Spend means what? To exhaust, to deplete. It's gone. Right. So when we spend money, we depleting it. Whereas when we loan money, we putting our money in a position to where it's going to come back. And that's done through borrowing and lending. Borrowing money, lending money. You feel me? Borrowing money. Even when you put your money in the bank, right? You are lending money to the bank.
Right.
Because why? Think about it. You don't just put money in the bank to just let it sit there. Right. You plan on using it or going and taking it out at some point. Right.
So let me ask you this. So it sounds like to me, if you have a savings account and you have $20,000 sitting in a savings account, you probably need to put that in your insurance policy.
Yeah.
Because it's not making you as much interest in the insurance in the bank as it would be if you had it in your insurance policy.
Right.
Wow.
You're absolutely right.
So y'all listen, if you got a lot of money you have sitting to the side, even if it's $5,000 sitting in your savings account that you you're pretty good at saving, sound like you need to have it into your. So let me ask you, what's the security? What's the security there? What if can I lose my money?
Oh no. I was actually gonna talk about that when you said 20,000 sitting in the savings account.
Okay.
Even the bank knows. So think about this. Your cash is an asset for you. When you deposit that money into the bank, it is now a liability of the bank because they owe it to you.
Okay.
Okay. So where do banks keep their reserves, their cash reserves? They keep them inside of insurance companies. So if you go to the FDIC stands for Federal Deposit Insurance Corporation, right? And matter of fact, any bank that you go, you'll see a sticker in the window that says FDIC insured.
Right.
Right. So if you go to their website, you can literally pull up the balance sheet of any public bank. The balance sheet just tells you what assets they have, what liabilities they have. Most banks, one of their largest assets is life insurance, right? If you scroll down to, typically it's like line 41, line 42 on their balance sheet. Banks literally have, I know Bank of America has 25 billion, would it be, dollars inside of life insurance cash reserves. And that's tier 1 capital, tier 1 meaning the best. Think about it like top shelf.
Right.
You drinking top shelf alcohol, that's tier 1, you know what I mean? Not tier 2 or 3.
Right.
Or well, it's the top level. You feel me?
So Brandon, let me ask you something. What about, I've heard corporations where they talk about corporations when they hire people, they actually take out an insurance policy on you.
Yeah.
Is that true?
Some corporations, yes. Some corporations, yes. Matter of fact, we talk about the banks. A lot of matter of fact, the strategy that we use, like with our clients, is the same level of policy that banks use when they insure their key level employees. Okay. So the thing about insurance is you have to have a person to insure. Right.
Okay.
And so if banks have all this cash, all this capital, the reason why they buy insurance is because they're able to get a safer, more predictable return on their money. What do banks do? They lend money. They lend for cars. They lend for all the businesses. They credit everything. And that's all credit that they have. Right. Insurance companies can't lend money like that. Well, they can lend money, but they can only lend dollar for dollar.
Right.
We only lend dollar for dollar. And the type of investments that insurance companies hold are things like corporate AAA bonds, such as the government bonds. It's basically the same thing. And so just like we as people have credit ratings, so do businesses and governments have credit ratings.
Right.
And AAA is the best. So if a corporation is listed as a AAA company, or like a government is listed as AAA, that means they have a really solid credit corporation or credit rating. And so insurance companies lend them money by buying bonds. Okay. So that's how they make money. It's safe, it's predictable. And that's why they got a lot of cash just sitting in reserves, because they can't spend that cash because they got a bunch of death benefits that they got to insure for people. Right. So go ahead.
No, because I'm trying to follow this. Cause I'm trying to think about what I'm gonna do with my little taste of change when I get me some. When I get all my money, all of it. I mean, all of it. When it start coming in, I need to know where to put my money at. Ain't gonna be no bit of change, you know.
Yeah.
So let me ask you this. To the person, when I say lay person, a person that may not have a lot of money, right? That's just getting started out into this whole thing, and they just getting into the workforce. I mean, what do you tell them? Do you tell them to start right now, get you a insurance policy? And if you do, what kind of insurance policy should a person get? Even if they only making a couple of $100 a month or whatever, what kind of insurance policy would you tell them to get?
So what I would say is the key thing you want to have starting out is financial discipline. You want to be able to build a habit of saving money. That's literally the only thing that you need to ever become wealthy.
Okay.
I don't care if it's $1 a week. You just start the habit of saving that $1. And then something magical happens. The way you start thinking about money changes. Okay. You go from a poverty mind state to an abundance. You know what I mean? So that's the first thing that you want to have. Now, what I will say for this type of insurance, you want to have some money already saved up, because insurance has costs, it has fees. And so if you think about like a car, right, you got to be able to afford to maintain it, put gas in it, get the oil change if you want to get the best performance.
Right.
So ideally you want to have consistent positive cash flow and be able to save money.
Okay.
If you can do that, then this is a good type of account for you to use and leverage. Now, when it comes down to the specific type of insurance, there's two types that are, I would say, the most popular, right? You have whole life, which is a form of permanent insurance. That's what a lot of people use as well. It has, I would say, more guarantees, but it's more rigid. It's not as flexible. Okay. All right. And then you have index universal life, which has less guarantees. And when I say less, the guarantee is 0%, whereas in a whole life, the guarantee is 2%. So it's like,
okay,
it's not like it's 0, but you get to earn up to 10. And on average, you're making 7, because index universal life is indexed to what the stock market does. So you're actually able to get stock market growth with 0 risk. You see what I mean? So it's a pretty safe way to be able to leverage your own cash, right? And so an index is a lot more flexible.
Okay.
Typically in whole life, you're going to have a fixed premium. It's more rigid, meaning like you have to pay the same amount. In IUL, you have a minimum premium and then you have a maximum premium. And you can pay as often as you want or as little as you want. But just understand that there are, when it comes down to designing an insurance policy, man, there's a lot of details that have to be gone over, man.
Okay. So it's not that simple just to go in and say, okay.
It's not that simple. Like, what I will say though, if you're considering getting an insurance policy to be able to do what I talk about, you want to work with somebody who's like doing it. You don't want to just go to just anybody and say, hey, have you heard of IUL or paying your mortgage through an insurance policy? Because that's just a conversation that less than 1% of 1% of people are having.
So that, I was going to ask you that my next question was going to be, how do you identify a good insurance? It's broker, right? Insurance broker, is that what you consider? How do you identify a good insurance broker? That how would I know that person is the right person for me, or that they know what they're talking about? How do you identify that?
Okay. Well, how do you identify? Well, you want to ask them some questions. The first question is, how long have you been doing this?
Okay. All right.
Okay. Is this all you do, or do you do this and have another job on the side? If they're doing two things, then that's no. Okay. Find somebody that only does this. The reason why I say it is because chances are they have two jobs because they don't make enough income doing this. Because this is a job where if you don't help clients, you don't make any money. And if you still need an extra job, that means you're probably not that great at this one. And I'm just being honest.
Okay.
You know what I'm saying? Or it just means they knew. And I was new because that's why I can say it, because I done been through this. You feel me? So I done been through the knocking on doors, driving around. Like I came. What this was a struggle. It was a struggle, man.
So I
wrote the struggle.
So this is all you do. You the good insurance guy. You the good broker.
Yep. Okay. So that's what so key point for sure. Ask, what do you do?
Okay.
Second question is, all right, what type of policies do you have? What insurance do you have? That's really the only thing you got to ask. And if they can't tell you what they have and why they have it, then
you need to keep searching.
Or they're fumbling around, or they don't even know. Like, then that means that's a salesman right there. You don't want to be talking to an insurance salesman.
They're not there yet.
They're not there yet. They're not there.
Okay, so Brandon, let me ask you this. So when you talk about insurance, a lot of things we talk about now, we've had COVID on the rise and stuff like that. A lot of people have pre-existing conditions and all those kind of things going on. And I think insurance policies, some of them are built around whether you do or don't have pre-existing conditions or something like that, unless we have something that Congress has passed that they don't ask those questions or something. But right. Isn't that a problem, or isn't that like one of the things that people will run against when they say, when you offer an insurance policy and they say, well, I can't get one because I have cancer or I have this, that, and third that I've had before. Isn't that an issue a lot of times?
It can be an issue sometimes. Every case is different. I've gotten people approved who've had cancer before, like breast cancer. If they've been in remission for a certain amount of time, then they can still get approved.
Okay.
Right. Sometimes we can submit things in a way to the carrier, because think about it, we're the brokers, so our job is to help the clients get approved. And so when we send in an application, it goes to an underwriter. The underwriter hasn't seen the client, talked to the client, or nothing. All they're doing is just looking at an underwriting guide and the application, and they're making a decision based on the labs or whatever they find. And so if they don't have like a background or a story or a cover letter, then it's harder for them to do their job. But if we dress it up, put a cover letter on there and say, this is what happened. Okay, this person was diagnosed with diabetes. They're currently taking metformin, but in the last 2 years or the last year or so, they've lost X amount of pounds. They work out regularly. These are their labs. This is their A1C level. Like, all those things come in. They help build a picture for the underwriter. You see? Okay.
So is there a particular group of people that you just simply can't write an insurance policy for due to health conditions, like people, I guess, HIV and AIDS and stuff like that?
Mm-hmm. Even HIV and AIDS, you could still get something like this. It depends on time, right? If you're newly diagnosed, then that is, insurance companies don't really like to see that. But if it's been 10 years or 5 years, whatever, and let's say you're healthy, then you can get approved.
Why don't they teach more about? Because I know a lot of people were like, when you talk about insurance, and the first thing is like, well, Alvin, I don't have this type of insurance because I'm gonna have this, that, and the third going on. And why is there not like a marketing campaign for that? Is it because the policy will be cost too much or something?
That's a tough question, man. In some cases, so traditionally life insurance is approached from the death side of it.
Right.
People tend to shy away, not want to think about death or whatever. So, and let's say you do have a critical condition like that, then that it even becomes more of a reason for you to have insurance. But at that time, it's kind of too late. So like the cost of the insurance isn't going to really give the type of benefit that somebody will be looking for, because in some cases the premiums could be too much. Okay. Now in our design, because we're using people's expenses to fund the premium, like we're taking your bill money plus a little savings that you could do, and we're building a policy off that. So you're actually able to pay for the account using your money that you already spending anyway. Okay. Because you're just flowing it through the account. That is something that we are trying to position the right way, because that is not the right fit for everybody, because sometimes the cost will still outweigh the benefit, but there's still sometimes some things that we can do, such as putting the insurance on a healthy person and then letting the unhealthy person own the policy. So they still get to take advantage of the cash benefits and things like that, right? But the policy will perform better.
I like the fact that you're real transparent about it, because I just heard you mention that sometimes the cost may outweigh the benefit, and to me, that's a good example of a good agent, because you're not just trying to sell a policy. You're trying to really help the person. So that's that stuck out. I like that. So what about age factor? How does that? What's the deal with that?
As far as getting approved, or as far as the performance of how the account could grow?
Getting approved. Is there a certain age limit that you try to?
You can get insured up to 85 years old. Up to 85. Now, what I will say, the premiums at 85 are going to be
high.
They're going to be up there. They're going to be high. But like I said, there are some creative ways that we can do and design these. The way we design these policies is so creative. Like when I first saw it, you guys, like I couldn't sleep at night, because I had been in the industry for 3 years. I had never seen anything I had never seen a policy designed in this way. And when it was shown to me, I tried to poke as many holes in it as I could. I was like, how come I haven't seen this? This can't be right, because not only am I learning more about insurance, I'm learning more about leverage. Like, a lot of people have been talking about credit and refinancing houses, and how debt is actually a good thing, if you use it responsibly. That opened up an entire new world, So even now, what I would say is age it affects us, but not the way we think it would, right? Mm-hmm. The older we get, now we're focusing more towards legacy. Right. We're focusing more towards legacy. Generational wealth at that point. Okay. So let's say, as a matter of fact, my mom is 61. Wait, 1960. 61. She'll be 62.
I hope she don't see this process. You're trying to figure out how old she is.
Right. So it's her. We're actually finally getting her through the underwriting process to have a policy the way we have. Okay. Now, traditionally, people use this for the way we design is meant to be more like a supplemental retirement income. Okay. Right. But the biggest factor in all investing is time. Right. The more time you got, the more money you can grow. Mm-hmm. So we can build the account for her to grow some money, but it's not going to be like $1 million, but it will be like a little bit. But the biggest part, and the part that she's more focused on, is the legacy piece. Mm-hmm. So she's in a position where she didn't have financial literacy. Nobody taught her the importance of saving and, credit and all that stuff, like putting money away, So she, and I picked up a lot of habits from her when I was younger, as far as like getting money and just spending it. That's kind of like what it is. You get money.
Yeah, that's what we do.
It's more. It's kind of like that. You always just, here's some money. Oh, gotta spend this. Like, you don't even really get to keep it, because it's just flowing right through you. Mm-hmm. But she for her, she's like a giver, right? For her grandkids, she'll do anything. Like anything, right? Christmas comes around, like she'll spend her last money on getting presents for the kids. I'm like, Mom, you don't need to buy them nothing. They good, right. But she don't care. Right. So for her, I know it's all about leaving something for the grandkids, and so we able to design her policy in a way to where it be more death benefit focused legacy fund.
Okay.
You feel me? Which is going to be a blessing for me and for my kids.
Right.
And we can just start keeping that money in the family. Like, as far like, we even have trust set up for the family. So like the way ours set up is we have a trust that owns all of our insurance policies. When the benefit pays out, that benefit pays out to the trust. The trust for tax purposes.
So
right, you want to keep that circulating.
So this is my last question. I'm actually this because I can keep you here forever.
Yeah, we can. That's why I got to come back.
Yeah, of course you're gonna come back. So yeah, I'm already thinking of. I'm thinking of that. We need to do an insurance series. You know. So tell me this: do you all set up trust, or that's something? Because I thought that the attorney does that, or you all do the paperwork financially for the insurance piece. Is that right?
We do the insurance piece. We refer over for the trust. We got some people that we work with that all they do is structuring. So whether it's business structuring or like estate planning type of structuring, they do that as well. It's a team. Actually, it's a team in Dallas, and there's a team in the DC, Maryland area.
Okay.
In that area who specialize in that. And that's usually who we refer people to, so they can help them out. One of them is Dr. Monica Andrews. Okay. Dr. Monica Andrews, if you want to check her out, she's on Instagram. I think it is at Dr. Monica Andrews.
Okay. All right. That's her. And so the one other thing, the last thing I'll say, then we'll come back. I want people to understand when you do the insurance, when you're setting up their insurance policies, and then they have to do all their medical assessments and stuff like that. And then they's like, well, I know Brandon. I don't want Brandon to know I got cancer or whatever. I don't want that to. It doesn't work like that, right? They do their physical, and then it comes back whether or not they do qualify or they don't, right? It's not like it's exposing themselves, their personal information to you.
Right. Yeah. We're not the doctor like that. We don't come out and do blood and urine. There's a nurse third party that contracts with the insurance company. Mm-hmm. They come out, they see you, and then from there they will send over all the details, all the information directly to the insurance company, and then the underwriter sees it.
Okay, and then whether the person qualifies, the underwriters want to know all y'all business, but the other people. So if you have a personal insurance person, you don't have to worry about. And I asked this question because one of my some of my business friends that I have, I was trying to explain to them about whole life insurance too, because I told them last week that I had you on the insurance. Like, listen, I don't know nothing much about it. I just had my little insurance for a long time, and I remember I learned about whole life insurance policies over 20 years ago. And I'm gonna tell you how I learned about it. One of my other friends was selling Prime America. Okay. And I'm like, what is this? He's like, listen, man, you got to get it. It only costs you $15 or $12. Alvin, just think about it. If you get it now, it's money. I was like, man, I only did it because it was a friend of mine. But he talked me into getting a whole life insurance policy, and then all the benefits there was. And so I remember you had to do, the nurse had to come out and do all this kind of stuff. And I was like, why you all in my business? Like, man, it ain't even like that. You know, so, and I said, how many people that probably won't do it? He's like, probably a lot of them, because they're wondering whether or not you're going to find out what their whole medical record's like and all that kind of thing. So I was like, that's not the case, but it's a lot of things in our community, specifically in our community, that we have pet peeves about. And sharing our personal information is one.
Is one. So, social, all that stuff. It's one of them things, man. But it goes back to mindset. That's why personal development is the number one step somebody got to take. You got to develop as a person, get out of the scarcity mindset, move to the abundance mindset. If you always think somebody trying to like scam you or do something to you, or, you know what I mean? Like, it's just kind of like, that's just you. That just says the type of person you are. And I used to be like that. So that's why I say it. Like, I had to shift that way of thinking and be like, okay, well, what's the worst that can happen? Somebody steals my information. What?
It's trust issues that we built over a while of our people. So put it like that.
Right. Yeah. Hey, but check it out. If you walk around believing that bad stuff is going to happen to you, or people's going to steal your information and do that, then likely that's what's going to happen, because that's you putting that energy out into the space. You know, if you believe good things going to happen to you, the good things going to happen to you. Like, even this whole opportunity that I got here today, because I took a leap of faith to get into the insurance industry itself. right? From there, I just learned. Like I just never was satisfied with just the basic knowledge. You know what I mean? Like if I do something, I want to be the best at it.
Right.
Like that's just it. And just by me wanting to be the best at this, I had to learn how to develop my personal skills, my personality. I had to become more of a well-rounded person, not be scared and not be like standoffish and,
right.
Just be more open. And that's just stuff that kind of just came along with the territory,
Wow.
And so I just want to share that because, we talking insurance now, but there's bigger plans. It's bigger than just insurance, man.
Oh, I'm gonna keep.
I want to preach
I got you.
The gospel.
Okay.
I feel the good news. I'm trying to bring the good news.
Man, I appreciate it. I really do. Brandon, thank you so much, man, for being on my podcast. And I want you to say you will be coming back, right?
Yes, I will.
All right.
Because we got to talk about the hedge fund.
Yeah, and that hedge fund got me like, okay. And yeah, we'll talk about the hedge fund because I was watching, I noticed this morning, read in the news that Bernie Madoff's sister and brother-in-law committed suicide today, for those that don't know who Bernie Madoff is. But he had a big Ponzi scheme going on with that whole thing. And I was like, wow. Yeah. But that's the reason why I asked, make sure you get the right people to work with you. That's important because a lot of people can be, swayed by the wrong people that they don't know what they're talking about. Yeah. Brandon said if the person got more than one job doing this, if they working at fast food and they trying to sell insurance, that means they just not ready yet. Doesn't necessarily mean they're not accurate. They're just not ready to handle your money just yet.
Yours yet.
Yeah. So
facts.
But I appreciate you, man. Thank you so much. Please tell people how to reach out to you, where they can get in contact with you and know everything about it.
Right on. So y'all guys can reach out to me on Instagram or on TikTok at Brandon Anthony Clark. I also have a YouTube channel. Just search my name. You can find me there. I post a lot of content there. Also, the website is www.brandonanthonyclark.com. And the only reason why it's my name and stuff, because I was so opposed to it, but one of my, and I'm so glad, and this is the last thing I'm going to say before I get out of here. I know why you said it. Come on, tell it. I want you to tell the people why. Last thing, one of my very first clients, he's in the real estate space. Mm-hmm. And he told me, he said, you know what you should do? You should get your name, give the domain, the address or whatever, just get it right now because it's digital real estate, right? He said, going forward, if you have a business, you have to market and you got to be searchable. People just got to know you. So you don't want to have like a bunch of, let's say, crazy stuff. You want to just something be simple, something easy. So just whatever you do going forward, just make it your name.
Make it your name.
Just be your name. Just be yourself, And so I took that to heart,
Yeah, I was always I had people I've heard people say that you're a brand. Oprah talks about being a brand. There's a lot of great things about being a brand. There's some scary things about being a brand too. But there's some great things about being a brand. I myself have just named all my companies my company's name.
Yeah.
Everybody might not like the fact that I'm vegan. Be like, Alvin's vegan, so I'm not gonna do no business.
Alvin, you the man, bro.
Yeah, it's like that.
You the man, Alvin.
But
you know what I'm saying?
You. But I'm gonna be on your podcast next. Let me know when you get ready. And
hey, all right, I will. And when I come out there, we're gonna do this face to face.
Yeah, we got plenty of room, man. You just see this.
You gotta get them vegan cheese grits, bro.
Come. I got you. Man. Thank you, man. Brandon. Thank you so much for being on the show. You have a great week. All right.
All right, man. You too.
Bye.
All right, bye.